Lots of people have asked me, why do we do short-term loans? In the world of sophisticated investing, time is the most overlooked risk factor. While most traditional real estate conversations center around the 30-year mortgage or long-term equity holds and things like this, the ZINC Income Fund operates on a different philosophy, high-velocity capital. In a shifting economic landscape, being locked in for a long period of time is an absolute liability. If interest rates pivot or the market pivots or fluctuates, that 30-year portfolio cannot move fast enough to adapt. This is why the ZINC Income Fund is engineered to focus on short-term loans, asset-backed lending typically of a year or less. We do not look at decades, we look at months. Specifically, we focus on the 9-month term, the 9-month sweet spot, maybe a year. Why 9 months? For a professional real estate developer, 9 months is that strategic sweet spot. It provides exactly enough runway to acquire a distressed property, execute a high-quality renovation, and bring that property back to the market for sale. For the investor, this 9-month cycle creates capital velocity. Instead of principal sitting stagnant in a single project for years and years, it is constantly being deployed, earned, and recycled into fresh, newly vetted opportunities. And this creates portfolio stabilization, because our portfolio is constantly getting refreshed with new valuations. Simply put, this means the portfolio is always reflective of current market values and current market interest rates. By keeping this duration short, we significantly reduce that duration risk that plagues traditional bond portfolios or long-term mortgage REITs. We just don't have that risk here at ZINC. We stay agile, responsive, and liquid. Risk mitigation. The 90-day extension logic. Anyone that has worked in real estate knows that the perfect timeline is a myth. Sometimes there's a supply chain disruption or a municipality permit delay or the crews walk off the job or unexpected weather that can push a project past its initial goalpost. And this does happen at ZINC. This is where most lenders and their investors can get into trouble. They either face a hard default or they're forced to liquidate and hurt the property's value. At ZINC, we build in a safety valve into our loan structure, the 90-day extension option. This is deliberate, and it's a risk management tool. By allowing a verified borrower a controlled 3-month extension buffer to finish their project if something goes wrong, we protect the underlying collateral as well as the relationship. We're not interested in gotcha lending or lend-to-own philosophies or predatory foreclosures. We're interested in a successful completion of that project and a successful outcome for the investor, because the finished house is much more valuable than a construction site. This extension ensures that the borrower exits at peak value, which in turn ensures the fund's principal and interest are fully repaid back in full. We only allow these 90-day extensions as a buffer to give them some time to complete their project. We refresh credit, we refresh valuations, and sometimes we ask for a principal pay down just to ensure that we're still in a successful position to navigate that exit. The exit strategy, DSCR in the secondary market. The most critical question for any short-term lender is, how does the borrower pay us back? At ZINC, we don't just fund that bridge loan, we fund the destination or exit strategy as well. This is where our integration with the secondary market becomes a massive competition advantage for the fund. We actually offer debt service coverage ratios or DSCR rental financing for our borrowers. We're connected directly to the secondary market. This is a specialized loan product for investors who want to keep the renovated property as a long-term rental. Instead of looking at the borrower's personal income, these DSCR loan evaluate the property's ability to cover its own debt through rental income. Not a lot of these. Because ZINC has established channels to move these stabilized loans into the secondary market, we create a reliable exit ramp for the fund's capital. So if a borrower transitions from a 9-month bridge loan into a 30-year DSCR loan, that bridge loan is paid off. The fund's liquidity is replenished, and the capital is ready to be redeployed into the next 9-month cycle at new valuation rates. My conclusion on this, very disciplined, and don't waver. A disciplined framework for income. This is the ZINC Income Fund's full cycle approach. We identify high-quality residential assets, we fund them with short-term, high-velocity loans, and protect the process with a 90-day safety net extension if needed. This ensures a clean exit through either a sale of that property or a DSCR loan to the secondary market. By managing every step of this pipeline, we remove the uncertainty that usually accompanies private money lending. You're not just investing in a pool of loans, you're investing in a very disciplined, defensive financial engine that's done $1 billion of this, designed to produce consistent monthly cash distributions to our investors regardless of which way the broader market is leaning. If you're an accredited investor looking for a vehicle that prioritizes transparency and capital preservation, which is what we do here at ZINC, and a professional grade underwriting, very disciplined, it's time to look at the ZINC Income Fund. Visit our investor portal to review our historical performance and download our current offering circular and a variety of other deliverables there for your reading enjoyment. Invest with discipline, invest with ZINC. Thank you for watching. Todd Pigott, Managing Member of the ZINC Income Fund.